Good morning, ladies and gentlemen. Well, the model score is pretty much unchanged on the week, as is the market, really. But Robson has been doing a lot of digging into the internals of the score, and we're not very far off from having negative score model numbers. I've been telling you for a while that I'm very dubious of a risk off which does not have a negative model score, and that it's likely to basically go sideways for a while. And that is precisely what's been happening. It's been going sideways. But should the model score go negative, I will be more inclined to believe the risk off that the model is indicating at the moment mathematically, because the moving averages are one below the other. What would cause such a move? Well, I think that the most likely thing to cause it is a period of negative numbers for the macroeconomy, which are now reflected in what I'm about to show you. We are in the very unusual position that realized volatility is now higher than implied volatility. This last happened, as you can see, in November and December of 2023, when we had very, very big moves. But also, what is interesting is that we are having a very high degree of return to mean. And I'm not going to show you that chart because it's very complicated and the interpretation is difficult. But what everything here is telling me is that whatever moves take place, they will be very, very quickly reversed. And the only reason why that could happen is because you get contradictory signals from the economy, i.e., a weak economy, but probably a period of lower interest rates, which then boost the stock market again, i.e., there is no trend. There is very high uncertainty, and the market goes from feast to famine very quickly and for probably very little reason. So I think this period will continue. I think realized volatility will be very high, while implied volatility stays relatively low. What did we learn from the QRA? Not a lot. Coupons are the same as we expected, but the issuance in Q3 and Q4, and as far out as the eye can see, will have to be raised in coupons. Even if they increase the amount of bills, it's just not going to be enough. And the fact that the Fed is basically doing the QT taper only relieves some of the bills issuance, which is massive anyway, and is not going to have any kind of effect on bill yields. So bill yields are basically stuck. As you can see here, it's, around the 35. What do you want to do? And they're not going to move for a long time, which means that the only thing that can move is basically the yield curve. Now, analyzing what Powell said, basically he has said that the bar to rate hikes is almost impossibly high. What does that mean? It means that two-year notes are very, very unlikely to yield you anything like Fed funds, and will always stay below Fed funds because the expectation will always be what Powell has said, and that is that lagging data will finally knock the growth in the economy back to normal and inflation with it, and therefore that he can ease. I mean, he has made it so clear that he wants to ease. It's not true. It's just that the data won't let him. He doesn't have the confidence that inflation will return to 2%. in his time frame, but he has high confidence that it will return towards 2% in time. So we are, the 2-year note is basically looking for the timing for when it will, the yields will collapse. That tells me that anything around this 499 area is a very good buy for the long term, simply because the market has an enormous amount of reinvestment risk. We don't know when Powell will have enough confidence, and he is unlikely to have enough confidence before he has seen the next CPI number, and that is on the 15th of May, I believe, and probably that one's not going to give him enough confidence, so then we're looking at the one after that, and the one after that, and the employment numbers. So basically from now on, it's just NFP CPI, until we get a figure which is low enough that he gets the confidence to cut. Hikes are just not going to happen unless you get a reacceleration of inflation, and with oil down at 78, that is, well, let's say unlikely. The odds are low. Therefore, we're looking for places to get long of the 2-year note, because we know that it's just not going to go above here. There are going to be too many buyers for too many reasons. And therefore, we know that the 2-year at worst is stuck, and at best is going to be the best performer, because, let's face it, that is the only thing that can move if Powell wants to cut rates. And why is it the only thing that can move? For anything else, for the longer duration part of the yield curve to move, the only way it can happen is if term premia go down. And I don't think that is possible, simply because you have so much issuance coming up. And Janet has basically given up on goosing the market. They did their move back in November when they cut the amount of coupons relative to bills, and they have now stopped doing that because they've realized that it's irresponsible for the long term. They've told you they're not going to play the political game that a lot of people thought that they would play into the election. They have told you they're not doing it. They're not lowering the amount of the TGA. They are keeping everything constant. Therefore, there is no goosing of the market. And what does that mean? Well, that means that with every new auction, and they're going to come fast and furiously like they have up to now, and we have, 250 billion of 3s, 10s and 30s next week, that means that that money, all of it, all the duration has to be absorbed by the private sector. And I just think that it's terribly unlikely to happen with term premia going down. I think it's far more likely over the course of the next 1 or 2 months that term premia return to about 40 basis points. So that would be another 20 basis points more of term premia, which basically, given the current situation, and that is one that 2s are at best, or let's say at worst, stuck, can only happen through a steepening of the yield curve. I just don't see any other alternative. Everything from now on is more or less fixed. You have an FOMC which is looking for data points to raise their confidence to cut. That moves the 2-year note. It doesn't move anything else. And if they move without the market, the bond market, have enough confidence, then the yield curve will really steepen, because the bond vigilantes will appear and say, you are cutting with this data, and they will lose confidence and term premium will really rise. So with this combination of where we are at the moment, with data being neither one thing nor the other, the Fed not having enough confidence to cut. Basically, when they do get enough confidence to cut, it's probably too late, which basically means that the 2-year note really rallies, and steepening is all I can see ahead of us. Therefore, the only charts that we're interested in are the steepening charts of the yield curve, because that is the only thing that can move at the moment. So this is 2s 5s. I'm still looking for a test of this 23 area, and that will give us the long-term trend. Then 2s 10s. I am still looking for a test of this 16 area. And finally, let's have a look at 2s 30s. And I think that at some stage they have to test this, 0103 area here. And then we are looking for a disinversion of the whole curve after that. And that tends to be a recessionary indicator. So everything is panning out at the moment to tell you that it's going to be a period of high indecision in the stock market and the bond market, because this steepening is not imminent, is it? I mean, you've seen all these charts, 2s, 5s, they're just going sideways at the moment. But the natural tendency, when the data give them enough confidence to basically, cut, has to be that it falls through these levels, and then we have a disinversion of the curve. Now, what is going to give them enough confidence? Well, obviously only weak data. And whether it comes from the inflation front or whether it comes from the economy front, i.e. unemployment, I guess, or whether it comes from a combination of the two, the result is always going to be the same. It's going to be a result of higher term premia because of the issuance, steeper yield curve because of the position that we're in, i.e. 2s are not going to go up anymore in yield, and I can show you that chart again, simply because we all know that they're not going to hike. And if they're not going to hike, you have to build in reinvestment risk into the 2-year note and the 3-year note, because when they start cutting, the cutting cycle is going to be what? 3, 4, 5 meetings, and that is a period of 6 months, 9 months, whatever you like. So it's the very short end, the 2-year and the 3-year, which are going to have the big moves down when it happens. In the meantime, the moves up are going to be very, very shallow, and the moves in the 10s and 30s or the 5s, because of the term premia which need to rise because of the huge amount of issuance, then I really don't see an alternative to the steepening. But it's not going to be quick, and it's not going to be now. Just like I'm looking for steepening in the US, I have to be looking for a steepening in Germany as well. But these charts are telling me that the likelihood of it happening quickly and now are not great. This is the Schatz, and I think the Schatz, just like the 2-year note, is going to have a very tough time going much higher, because the ECB should be the Fed squared. And the Schatz is telling me nothing. And if you look at 2s, 5s, that's still not breaking down. They are going down, but they're not breaking down. I would expect at some stage that they should be, they should start breaking down. And if we look at 2s, 10s, much the same kind of situation. You have to think that, 2s, 10s will trade to around the 25 area. So I think it's the same story in both markets that the natural tendency should be for a steepening of the curve, but the charts are telling you that A, it's not imminent, and B, that it's just sideways and indecision. When they start being impulsive is the time to start getting aggressive. Now it's not, and that's why when I do something in the steepener, I do a little bit, and I'm nowhere near my maximum levels. And even if I get long of the twos or the shats, I'm nowhere near my maximum level, simply because the charts tell me it's not imminent. The differential charts also tell me absolutely nothing. This is the shats against the 2-year note. We're going nowhere. If we look at bobble against the fives, it's a range, isn't it? Yeah, I think the bobble should be doing better than it is, but it's not. The 10-year against the Bund, we are in a very narrow range. We are going up as the issuance in the US has, its weighs on this spread and makes it keep on going out. So I still think that we should prefer Germany on a trading basis, but it's really not very clear at the moment, and I think it's likely to remain that way into next week, when we have absolutely zero data in the US and all we have are the auctions. I would expect next week that we should return towards this 210 differential level in the 10s, and the 5s also we should return to at least 208 because of the auctions. But otherwise it's trendless. It's returning to trendless. This short period that we had of move back up to 220 has been reversed, and that tells me that we're basically just going to go sideways, and that tells me that we're going to be mixed in the data that we have, and neither the ECB or the Fed are going to be particularly aggressive until they see some data which makes them move finally after, 11 months of holding rates steady. Well, on Friday, as a result of the NFP, where the bond markets moved and the differentials between US and Germany moved, you got the dip in the dollar that I thought we're likely to get. But it was quickly, reversed and neutralized, because it really doesn't mean very much. So what are we going to get? I think we're going to get more of the same that we've been getting for quite some time, and that is technical moves from the moving averages to about somewhere right there. So I would have thought the top of next week is going to be somewhere around the 105.60, and the bottom for the week is going to be somewhere around the 104.80. I think next week is going to be a sideways week, and if we look at the Euro USD, what does that mean? It means that we're very, very unlikely to break through this 108 level up here. You can see all the moving averages, the 200-day moving average, the 50-day moving average, all pressuring it. And, we're likely to return to something like this, and that's going to be a range, 106.90 to 107.90. A very quiet time for the dollar. No reason for it to move, really. As I remarked to you on Friday, gold for the very first time did not take the opportunity to go higher on a stronger bond market and a weaker dollar, which basically means that the Chinese are less afraid of devaluation, and they're not buying gold in such big numbers, and gold, which was far too high relative to what real yields are, is basically normalizing its relationship to real yields. What does that mean? It probably means that this is some sort of an ABC that is going to test these kinds of levels, 2240, 2250, but it's going to do it very slowly, and it's going to take its sweet old time. I think any rally to around this 2230 level is 2235 is a sell, and it's going to be a quiet period for gold. But I think really the chart that you are looking at is the one of the normalization of its relationship to tip. And this is GLD over tip with the adjustment for the dividends. Unless the Chinese are afraid of imminent devaluation, they're not going to buy gold hand over fist, and I guess this is what was happening. So it's a normalization of the relationship that gold normally has with tip, and I really wouldn't be surprised if it returned towards this 190 level. The only way that can really happen is a combination of a steady bond market and a slow drip in gold, which is what really makes the most sense at the moment. And I've been quite surprised by the weakness in oil. Where does it make sense to buy it? Well, around this 75-20 area, let's call it. That would be an ABC almost perfect, and test these levels and stop a lot of people out. So while oil is weak, we are unlikely to get too much pressure on bonds. We're only likely to get a steepening of the curve, because the more oil goes down, the less the Fed should fear inflation reigniting, and the closer it should be to deciding that it wants to cut. So that's all basically coming together. You are having a commodity sector which is at the moment weak. You're having a normalization of gold against dip. You're getting a bond market where the natural tendency has to be to steepen and for the term premium to rise. It's all pointing in the same direction, that we're not going to have huge moves imminently. DBC, well, just like oil, nothing much to see there until we see these lower levels around the 2250, which seems logical to me, where the first bounce can happen. Certainly I don't think we go through 2175 anytime soon. This is more likely to be a period of sideways to down towards the 2250 area. And that's all I can say about it. I don't think that we are about to have a massive move in commodities, so just trade it. So let's have a look at the SPX through the very clean chart with the levels. I think we are likely to get an extension up to this 5180, 5190 area, and we have a gap here to this close of 5198. So, it's 80 to the figure, that kind of thing. But then we are very likely to have a move back down towards the lows. It's what I've been saying. It's a period of high likelihood of normalization of returns, i.e. that every move up and down is negated. And that makes sense with the background that we've had all the earnings that we're going to have, that are market moving. We've had Apple and Amazon, and we don't have Nvidia until the 22nd, so next week nothing in terms of really market moving events. So I would have thought the most likely range is here between 50.50 and 51.80 to 5200. That's why I did absolutely nothing on Friday, and I just couldn't see the point. I think the likelihood is that we remain in this range for quite some time. I don't think we've got the ability to break it to the upside, and I think it's very likely that we re-see this 50.48 level at some stage over the course of the next couple of weeks. New month, so always interesting to have a look at what the monthly bars are. And we are at, this is the support, 50.10, 50.20. As I showed you, very unlikely that we go down and break it next week. It's not something that I expect. I would expect an inside week, as it were, with it. Well, no, that's wrong. I would expect it to fill the gap to the upside and then come back down on the weeklies. But I'm just showing you the monthly because I'm showing you the support. And I think it's going to be very difficult without data to break this support around the 50-20 area on the SPX. It's very strong monthly support. It's where we broke through the upside of the Bollinger Bands on the monthlies, and we always return to retest that, and we've done that. So it's very, very unlikely to me that we start breaking it anytime soon. If we look at the NDX monthly, much the same kind of picture. We are basically retesting the levels around the 17,200, and we are very, very unlikely to go below them anytime soon. I would have thought next week a range between 18,100 and something like 17,650. That is where I would expect the market to trade until it makes up its mind whether it's going to do a quick ABC down to these kind of levels in a couple of months or continue higher. I think we don't have enough data next week. We don't have enough of anything to break these equity indices out of this range. The interesting thing to me is that EEM is finally starting to perform, but it's reached all my targets. It really doesn't go very far away from this 42.25 level it reached, which was my target. It might go a little bit higher, but the likelihood is that we return and retest certain levels. The interesting thing is that EEM against the US is beginning to move out. The performance of EEM in 2024 is actually slightly now beginning to catch up to SPY and even exceed it, which tells me that the pressure on SPY can only be so limited, and therefore I really don't expect very much on the downside in either of these next week. Well, what is interesting, as I showed you at the beginning, is that the VIX is so low and basically went down all week last week, and yet realized volatility is so high, i.e. the ranges are so high, but net volatility is going down. So I would fade all rips and I would fade all dips. That is what that relationship is telling you, that it's not really going to go anywhere fast, but it could go fast, but at the end it will go nowhere. And that is what makes most sense in this environment. For all the good it's going to do, I've changed the levels. The only thing that I'm interested in doing is playing steepeners and getting long of 2-year notes at decent levels. I'm going to trade the 2-year note because I don't think the moves are going to be huge. I'm going to trade the yield curve because I don't think it's imminent. I think I got long 2s 10s and 2s 5s because I think the auctions next week are going to give me a couple of basis points on those positions, but I'm going to be out of them and I'm going to be looking to buy the 2-year note again on some kind of retracement. No data next week tells me that next week is not the week that the 2-year note makes a massive move to the upside in price or downside in yield. And therefore, that's all I can do. I think gold is the one that could suffer next week because of its relationship, or maybe not next week, but in the next 2 or 3 weeks, because of the normalization of the relationship against tips and the fact that the Chinese yuan is looking better and better in terms of not devaluing against the US. So those are the only things that I can see that are really going to be interesting to trade. The other one would be if SPX got up to this 5180 to 5200 level that I showed you and filled that gap. That to me is a good level to sell call spread or buy put spreads, and that's really all I'm interested in doing next week. Thank you very much indeed, and have a lovely weekend.